What's up, investors? It's the Russian Dude. In today's short video, let's talk about why the upcoming Federal Reserve pivot might potentially crash the stock market. The reason for this mainly it is because of not so great employment jobs data which started to come up recently. For example, the non-farm payrolls added a very small number of jobs, which, as you can see from this graph, is nowhere near close to the data we saw just several years ago. And I mean, yes, this is exactly what the Federal Reserve wants. They want to see the employment data, the jobs market to slow down, which basically means that the economy itself slows down, and this will allow them to also fight against the inflation, which inevitably will allow them to start cutting the rates. But well, now with all the rhetoric that the interest rates are coming literally within a couple of weeks, well, the jobs data still does not show any signs of moving in any direction. So right now, the main fear is if Federal Reserve starts to cut the rates, will this restart the economy, or will it again struggle to create new jobs and to restart the economical activity in general? Because of this, right now there are big debates whether the Federal Reserve will cut the rates by 0.25% as previously expected, or maybe the cut will be much more significant, something like 0.5%, pretty much 2 cuts in a single day. And while a lot of people think that this is a possibility, the main consensus, at least for now, is that there will be at least one cut of 0.25%. The chances of this happening, according to the market participants, are 70%. But despite the fact, even if we do not see 0.5% rate cut, by the end of the year a total number of 3 cuts is expected, bringing the rates down by 0.75%. But honestly, if you think about it, why would the Federal Reserve detour its own strategy? I mean, there were signs that there will be one rate cut of 0.25% in September for a very long time. The Federal Reserve gave us a lot of hints that this will happen. And now, when it's only a couple of weeks left, there are talks about 2 rate cuts which will equal 0.5%. Honestly, once again, if you think about it, this can be only seen as a sign of trouble. That something is about to break, that the economy is struggling, that something is not yet under control, which will allow the Federal Reserve to try to take a little bit drastic measures in this once again upcoming Federal Reserve pivot. And if the market participants will also see this as a sign of trouble, the cutting rates of more than anticipated, well, this can cause some of them to start fearing what's gonna happen next. They might liquidate their positions, locking in some profits, which in return will decrease the asset prices. Other market participants will see this as well. They will hear the data of 0.5% rate cut instead of 0.25% rate cut. They will understand as well that the only reason why would the Federal Reserve do this is that in case something is not going according to their plan, well, eventually this can create a panic on the stock market, at least a temporary one, but enough to decrease the prices of some assets by double digits. Another thing which predicts the upcoming troubles on the market is this graph, which shows the correlation between the treasuries yields and the federal rates. Well, as you can see, since 2000s, the correlation, they were pretty much going in unison. Whenever the rates are going up or down, the treasury yields were going up and down as well. And the difference was not that significant. And usually it was treasuries which were kinda predicting the future direction of the federal rates. Well, as you can see right now, the situation is drastically different. As different as in first time in a quarter of a century. Basically what we are looking at, represented as a gray line, the treasuries yields. They are approximately estimated to be at a little bit under 4%, while the current rates of the Federal Reserve are estimated to be at approximately 5.5 to 5.75%. The difference, as you can see, is more than 1.5%. So basically, according to this logic, it is estimated, or at least it is expected, that in order for the economy to be in the same unison, the very same thing which was happening for the past 24 plus years, the rates need to be actually cut by more than 1.5% by the end of this year, which is nowhere near close to the number we're expecting of 0.75%. This is yet another indicator of a big underlying fear that stock market participants they have, but they're not showing it just yet, hoping that the US government and the Jerome Powell administration will be able to handle the situation. But as you can see, the fear is 100% there. They're just waiting for one event which can trigger this chain reaction. And according to some other economical experts, such as for example Peter Schiff, he already considers that the US economy has already entered the recession stage. It is just not that obvious yet, it is not officially recognized, but guys, we are there. So please let me know down below in the comments if it makes sense whatever I just said. If you did enjoy today's episode, please like this video, subscribe to my channel, and see you tomorrow.